Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing AbCellera stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. AbCellera is a biotechnology company that uses its proprietary database to research and develop human antibodies to address pandemics and common diseases. The company establishes partnerships with small, medium, and large drug companies. Those drug companies tell AbCellera the idea for the therapeutic agent, and AbCellera performs the entire discovery process and validates the work. It then turns everything over to the drug company for clinical trials. They make money by locking in royalty agreements with other companies, which creates a long and healthy revenue stream. Most of its revenue comes from royalties. The company is headquartered in Vancouver, British Columbia, Canada, and was founded in 2012. The ticker trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 2.3 billion market cap. They're trading at $8 a share, and they have 285 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a small negative in 2019. It grew to 8 million in 2020, then jumped way up to 186 million in 2021, and it's 166 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that peaks in the trailing 12 months at 205 million. Revenue is the sales for the company, and that goes up a lot from 12 million to nearly $500 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and their gross profit doubles from 2020 to the trailing 12 months. Below that is their operating expenses. R&D is a big operating expense for this company. Gross profit minus operating expenses gives you your operating income, and that was negative in 2019, almost 300 million in the trailing 12 months. They have hardly any debt, so they didn't pay any interest on their debt in the trailing 12 months. Then other income and expenses. These are all the gains or losses not part of the company's core operations. Your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is highest in the trailing 12 months. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You can see they generated lots of cash flow in 2021, a lot higher than 2020. It was mainly from the royalty agreements from their COVID vaccines. Then you have capital expenditures, investments in property, plant, and equipment. They spent 69 million of capex in the trailing 12 months. Operating cash flow minus capex gives you your free cash flow. And they do have a good amount of free cash flow in 2021 and the trailing 12 months. It was really low in 2020 and 2019. Most of their funding was in 2020. They added 600 million of capital stock and 100 million of debt. But before and after 2020, it doesn't look like they added much debt or equity. Let's look at the capital structure. 1.2 billion of equity, 40 million of debt. They're 97% equity, 3% debt. And they could pay off all the debt with the cash on their balance sheet and still have 746 million of cash left over. I gave them the lowest whack on Finbox, 8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 555 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $600 million. We divide that by 285 million shares. And we get a calculated stock price of $213. They're trading at $8, so they're trading at a 278% premium. It's a sell according to the model. Their revenue target for 2024 is supposed to drop a lot to 84 million. It's supposed to be 76 million in 2023 and 450 million in 2022. And I gave them 92 million of revenue in 2025 based off of the revenue in 2023 and 2024. They convert 32% of their revenue into free cash flow, so I multiplied their future revenue estimates by 32%. That's how I got their future free cash flows. So maybe a DCF isn't good for this company because there's so many unknowns about the revenue for the future. A DCF is ideal for a company that has positive and consistent numbers. I own this stock even though the model says it's a sell, because I believe in the future of the company and I like their business model. 5 analysts priced this stock and the average price target of $30, the lowest $14, the highest $43. This is where the stock has been trading since it IPO'd. It was close to $60 in the beginning, but it's pretty much only gone downhill since that point. The stock is down 66% in the past 52 weeks, while the S&P is down 8%. The 52-week low is 542, the high is 27. And the stock is trading below its 50-day and 200-day moving average. 2.5 million shares are traded each day on this stock. Of the 285 million shares outstanding, 207 million are on float, 40% are held by institutions, and over 7% of the shares are shorted. If you invested $10,000 into this company when they started trading, you'd have $1,700 today. That's an 83% loss. The CEO's annual salary is $400,000 and their total compensation package is $9 million. Here's all the buying and selling activity in the past 12 months. There was some selling last year when the price was higher. There's a lot more buying this year, especially now that the price is below $10 a share. 40% of the companies held by institutions, 32% by the general public, and 27% by individual insiders. Their employee count has gone up a lot the past couple of years. They're currently at 400 workers. Here's a list of their top 10 biggest shareholders. The founder and CEO, Carl Hansen, owns 20% of the company. Then Capital Research. The famous investor Peter Thiel owns 3.5%. The huge Japanese fund SoftBank owns 2.7%. Let's look at their financial ratios. They have a really good PE of 11, that's stock price over earnings per share, much better than the market median average. Price to sales of 5, price to book of 2, and a price to free cash flow of 14. They have a really high return on invested capital of 50%. They have an ROE of 17%. A really low current ratio of 0.3, that's current assets over current liabilities. So they're definitely going to need some funding to get through the next 12 months. They generated $166 million of free cash flow in the trailing 12 months. They have negative $144 million of working capital. So if they do generate a similar amount of cash flow in the next 12 months, they may have enough money to pay their bills. The best way to look at ratios to compare them to companies in the same industry. There are 762 companies in the same industry as AbCellera. And if AbCellera has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They rank 47th in market cap of all the companies. They do have a really good PE and price to free cash flow. The main risk is they may not be able to generate a similar amount of free cash flow and earnings going forward. Because remember, these ratios look at the past, not the future. So to summarize, I have them trading at a 278% premium. But the nice thing about this company is they've already generated revenue. A lot of companies in this industry take a really long time to bring in revenue. They've already proved their product works. And they have lots of products in the pipeline. Even if they assist a company with developing at least one drug, that could bring in a lot of revenue. So I'm really excited to see how this company progresses over the next few quarters. I ranked their free cash flows, revenue, and ratios 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.